like Rick Rule likes to say, don't confuse the inevitable with the imminent. This isn't just inevitable, it isn't just imminent, it is happening now.
Special coverage of the New Orleans Investment Conference is brought to you by Victoria Gold, leading Yukon's new gold rush.
Welcome everybody, SF Live on site. We're here at the New Orleans Investment Conference, special coverage. We are media partners here, excited to be here. Fantastic conference, great guests, great speakers, and we're joined by Lobo Tiggre now. Thanks for coming on and good to see you.
Good to be here in person, Kai.
Absolutely. Last interview we did a couple of months ago, we had to do virtual obviously, so Frankfurt, Puerto Rico, there's a bit of a difference.
And the last time I saw you in person was at PDAC, and there were more people on stage than there were in the audience.
Oh, that's right. We did the panel together there
right.
as well. Oh.
So here we are, and it's a booming show. So
it's fantastic, yeah. Like full room, the ballroom is full. People are excited, or I wouldn't say excited, inquisitive. They're curious.
That's interesting that you mentioned that. Yeah, the mood, you might think, given how gold seems to be broken, not tracking inflation and so on, that the mood would be depressed, but it's not.
No.
It's, people are looking for opportunities.
They're looking for a bit of guidance, it feels like. People are really paying close attention to what the panelists and the speakers are saying.
It's not euphoric for sure.
No,
but it's not
far
depressed.
from it.
Yeah.
Far from it. But I think people are understanding that we're in an interesting time and they have to change some of their investment behavior. Like I had Brian London just mentioned earlier, is like 60-40, meaning 60% stock, 40% bonds, is not a ratio or anything that still makes sense. Right. Do you agree? Like, getting a bit off topic here, but...
Well, let me rephrase it this way. For a long time, people have been, the mainstream finance has been talking about TINA, right? There is no alternative, which was never true. There was always an alternative. Resource investors knew that well. But what they were talking about was the 60-40 model being broken. And interestingly enough, now, with the tightening cycle, then suddenly, bonds are paying coupon worth having. It's not enough to make up for inflation, but suddenly it's not zero, right? So suddenly there is an alternative that mainstream is looking at, and that's broadening perspectives. And it'll be interesting to see if that spills over, particularly if the inflation persists. Right? We're hijacking the conversation, Guy, but you're going to ask about CPI. We had a hotter than expected CPI print. The so-called core went up to 6.6. That's not what anybody wanted, certainly not what the Fed wanted. And we also had the unemployment, the jobless claims tick up at the same time. So it is looking more and more like that we're heading for a 70s-style stagflationary environment. And in that environment, the alternatives that people will look for, there is an alternative now. I think that could be a real eye-opener. And where do you want to go from there?
Yeah, good question, because your original presentation title was Speculating in a Changed World, sort of fitting what we just discussed about. Like, so what are you looking at? Of course, you're a mining stock speculator, you look at mining stocks primarily, but overall, like if you look at the macro more, has your investment style changed a little bit? Like, are you looking at other asset classes, or are there other asset classes?
Well, there should be, but I'm extremely cautious on these things. If it's metals and mining, I understand. Right? So that's where most of my focus is. If it's not that, then it's real estate, and it's either productive real estate or something I understand, or something that I just want to own anyway. I don't consider art an investment, but if there was
wine,
the value is just so subjective. Not even intersubjective, but subjective.
Cars similar.
Yeah. So, but if I wanted to own that piece of art and it might appreciate, that would be different, right?
Sorry to interject, but I listened to a conversation on Twitter Spaces this morning and said we got to look. There's always a bull market somewhere.
Well, that's right? Jim Cramer. We don't want to quote Cramer.
Was it Cramer? I don't know. No, it wasn't Cramer on the Spaces, but
no,
it was
that's a Cramer saying.
Oh, okay.
That's his thing,
Right?
And money. There's always a bull market.
Yeah,
somewhere.
but funny enough, they were talking about commodities, oil and gas, and energy services.
So let me throw this mad money idea out there. We've got the dollar has been the wrecking ball, they're calling it, the dollar wrecking ball. And because the Fed led the way in tightening, the dollar has gone up to not quite nosebleed levels, but lofty valuations. The DXY it's nowhere near an all-time high, but it is well above average.
114, I believe, or so, unless it's changed drastically today.
High, right? So long-suffering gold bugs or any resource investor has been taking it on the chin because of this dollar wrecking ball and the dollar milkshake, right? But Brent Johnson's dollar milkshake thesis is not that the dollar goes up forever. It's just about why it happens, and it's reversible, right? So, one, if the Fed led the way into tightening, and it ends up leading the way into, if not loosening, but easing off the brakes, that same dollar milkshake mechanism could put that elevated dollar into reverse, which would be very good for the alternatives like gold and the euro and other things. The shenanigans with the pound right now are bollocksing things, but that aside, remember this, folks. The dollar milkshake mechanism is reversible, and at some point it will reverse. Even Brent Johnson says so. The other thing is that expectations for inflation, I hate that, expectations. I want to deal with facts and figures and physical reality. But in a fiat-run economy, expectations do matter. And the expectations have been persistently low for inflation. Like, people are still drinking the transitory Kool-Aid. They think the Fed's going to succeed. And yet here we are with the CPI and numbers saying it's not working, right? And this is the big difference between right now and the 1970s. In the 1970s, everybody knew that anything you could buy today, you should, because it'll be more expensive tomorrow. And that's what really lit a fire under gold, was the entrenched expectation of higher inflation, and that's not happening yet this time, even though we have persistent high inflation.
But there's no urgency. Like, there's not that, as you mentioned, that sense of urgency,
that's the missing
right?
ingredient. That could
Or
be
fear,
around the
to a
corner.
degree.
That could be around the corner. When people start saying, "Holy cow, the Fed's doing all this and it's not working," suddenly their expectations shift. And if that happens, we could see, set aside the dollar milkshake, you could see the dollar and gold both going up. Even though the dollar shouldn't go up, cleanest shirt in the dirty lawn, all that stuff, right? It could still go up. I'm not promising that. What I am saying is that the dollar doesn't have to be the headwind it has been for gold and silver and anything else real. Once the people's expectations and attitudes change about inflation. And I'm not sure how many hotter than expected prints, how many times can the economists get their projections wrong before people start saying, oh, that day will come.
It's interesting, like, we've had that conversation, I think, as well. The US dollar is so strong, and I remember the past president talked about, well, we got to weaken the dollar to make America great again, to bring manufacturing home, to make it actually economically feasible to produce at home. Now we're sort of forcing ourselves to produce at home. How can inflation be transitory in that regard? For me, that just screams cost creeps.
Right. So you're putting your finger on a key point, which everybody should remember. This, how can the dollar remain strong? It's not strong in terms of value. There's no question. That's what the CPI is telling us. The value of the dollar every month compared to last year is significantly down. You're losing a lot. Twice what you can get on your best bond right now. So it's not strong, but it looks strong compared to all the other garbage out there, the fiat currencies that are being debased as well. So the so-called strength of the dollar, it's really an optical illusion. It's just its relative standing compared to all the other dirty laundry in the hamper, right? So I call it the wrong trousers. People look at the DXY and say, oh, the dollar's strong. It's the wrong trousers. It's the wrong measure. And how much, the dollar, which of these garbage currencies is winning the race to debase at the particular day has really nothing to do with how, the value of steel for construction or whatever. I mean, the economy impacts that, or the value of gold and silver. That is a real physical thing that has a separate mechanism. But people look at the wrong trousers, and these traders. I think part of the problem. This is one of my pet peeves. If you'll indulge me. I, like other gold bugs, would love to see the day that we stop using futures contracts as so-called the price of gold. That's not the price of gold. That's the price of futures contracts. The advantage of them is that they're extremely liquid and they're reported electronically in real time, so they're easy. But it's just not true. That's not the price of gold. Go on eBay and try to buy an ounce of gold, or go into your local coin shop. That's not the price you get, right? But those guys who trade these future contracts, they look at they have these models, and one of the prime inputs is the DXY, the wrong trousers. So that's why, even though it's the wrong thing, the model is wrong, it's broken, and we're about to see that in spades with stagflation. The traders who use these incorrect models are leading markets in the wrong direction. And It's painful, it sucks, it's no fun. The good news is that when that breaks down, I think the snap back to reality will be very good for people.
Well, we've sort of
invested in
seen a
real
glimpse of that, like 10 days ago, roughly 10 days ago, when the Bank of England
Yes.
sort of went back to quantitative easing because they had to pump money into the pension funds. And all of a sudden, gold was up $100, silver shot up $3, but also all the other main markets shot up drastically because everybody sensed a potential pivot by the Fed. Like,
Right.
is that what we can expect if actually there's a pivot, all of a sudden all risk is off and we can go and Bob's your uncle pretty much, like all the assets are going up?
Yes, I wrote about that and I called it proof of concept, right? I didn't expect it was a
okay,
flash in the
yeah,
pan,
yeah,
right? I didn't
exactly,
expect
yeah.
that to last, but it did show specifically that the
Like,
dollar milkshake mechanism
brutal,
reversed,
yeah.
right? And then all the things that we're hoping for when that reverses, that happened, right? So it was excellent proof of concept. And then we'll see, like, the Bank of it. The irony is that the pound went up because they did QE.
Yeah.
And it should have been the opposite. But it went up because there was systemic fear. Like what they did calmed the systemic fear, and that's interesting. But it amounted to QE, and the idea that I don't know the future, I don't have a crystal ball that I can predict the future, but it looks to me, and I'm not the only one saying this, many of the talking heads on financial media are saying the Fed's going to go until it breaks something.
Yeah.
Well, if it breaks something, like
Isn't that too
something
late?
happened, well, yes, but it implies what we just saw, what you pointed out in the UK.
Yeah.
What happens when something breaks? They pivot,
Yeah.
right? But you know what? Even if they don't pivot, if they just do, things don't break. They take rates up to 4.5%, close to 5%, and then they pause, like they're
Yeah.
saying, to see how our policies are impacting the economy. That's very much on the table. They've already, projected a terminal rate, right? So by the end of this year, they should be done raising rates for a while. It doesn't mean a pivot,
No.
but that alone, especially if Europe is still getting it on the chin from the war and the energy, and double-digit inflation in Europe.
10% today in Germany.
Right. So if the ECB continues to tighten while the Fed is pausing to evaluate, that would reverse the dollar milkshake mechanism.
Yeah.
So even without an actual pivot, we could, and I think probably will see the dollar roll over for a period, and that will be good for real assets. But then who knows? Maybe we get a UK moment, something goes Lehman on us, and the Fed does, even the Fed says we're data dependent,
Yeah.
which means we reserve the right to completely do the opposite of what we're saying today.
Keeping the door open there. Yeah. Fantastic. Let's come back to the conference real quick. Like, what did you actually talk about? Because the title was a bit different. And what was one of the key takeaways that you wanted investors in the audience to sort of walk away from your presentation?
Okay, so real quick, I was sort of the professional rain on the parade this time around. Maybe not the right thing to do when the markets aren't so frothy, but just there's a lot of hype out there, and I felt like it was important to remind people to be realistic, look at the data. And so there's a lot of hype around silver and how silver hasn't had its data catch up and silver's going to go nuts. But the data tells us that silver's role has changed or is changing. And there's free stuff on my website about this. I've been dubbed Darth Silver because of my so-called bearishness on silver. But I'm actually not bearish on silver. The Darth Silver thesis is not that silver is not going to go up. I'm actually very keen to add silver stocks to my portfolio. The Darth Silver thesis is that even if we get a new gold standard, silver may not be used as a monetary metal again.
I've heard that before. You're not the only one saying that. Even
like
some of the silver talking heads are saying, well, it can't be a monetary metal in that sense. It can't be used to back a currency because there's not enough.
Well, I don't know. There's enough. I mean, silver gets used.
Yeah.
Right. That's why the stocks are small. They seem small because it's continuously used. But my view is that with the digital receipts, right, you have instantly transferable, infinitely divisible. Like the reason why you had silver was because gold was so precious, you needed silver to make change, or copper to make change for silver, right? Now, if you can do, 1/10,000th of a gold coin, electronically, you don't need the other metals to make change. And that's just one example. Clearly, silver's industrial side is ramping up big time. And that is changing its price dynamics. And I actually think that's a plus, because I think silver as an energy metal, which it is going to see very robust demand, even if monetary or safe haven demand goes down. The other big one was nickel. There's a lot of hype about we're going to run out of nickel. There's not enough nickel. That refers to so-called class 1 nickel traded on the LME, but there's a lot of other kinds of nickel out there, not traded on the LME. And people say, yeah, but you have to have the class 1 to make the batteries, right? Well, but the other kinds can be converted. Ultimately, nickel is a metal, it's a chemical element. And at the end of the day, if you've got to have the nickel, the battery doesn't care, what kind of deposit it came from. But the other thing is, never mind the theory, the reality is you've got Tesla going to Indonesia now to get non-class 1 nickel. They're contracting directly with some of these intermediate providers. So it's just not true that you have to have and can only have class 1. And we have a free report on the nickel market on the website. I think it's important to look at that, even if you're not interested in nickel specifically. The proof of concept, or the walkthrough of the thinking process here, and looking at the hype versus the reality, I think that's very important. Another bit of raining on the parade was I love uranium. It's my highest conviction trade for the near term this year, and unlike the other yellow metal, gold, uranium's up this year.
Yep.
And despite market volatility, my uranium stocks on average are up. So I'm very happy with uranium, but people get religious about this. And if I talk about taking profits, you're like, oh, he lacks conviction, there are all kinds of, Darth Uranium. But nobody goes broke taking profits, as they say. No. And you sleep better. And in particular in this case, I'm extremely bullish on uranium. And it's happening now. This isn't, like Rick Rule likes to say, don't confuse the inevitable with the imminent. This isn't just inevitable, it isn't just imminent, it is happening now. Long-term contracts are being signed now at higher prices than spot. So I'm extremely confident in this. But this is literally an investment that can blow up on us. Yeah. And Europe's largest nuclear power plant is right now in the middle of a war zone. This isn't just rhetoric, this is serious people.
Yeah, you could wake up in the morning and all of a sudden
the
power plant has been destroyed, and that's you get a second
uranium
Fukushima.
Stocks would be, just step off a cliff.
Yeah.
So in a market where that can literally happen overnight, it's not lacking conviction to take profits. It's insane to leave that money completely at risk on the table, as bullish as you may be. So I was kind of the professional rain on the parade this year, but it was in a good cause. I was trying to encourage people to, as enthusiastic as you may get about whatever you're investing in, take a step back, breathe deep, and try to be rational as a speculator.
No, fantastic. Great closing words.
Well,
Nothing to add.
Very much.
Lobo, thank you so much. It's great seeing you. Thanks for coming out, or thanks for coming on. And to everybody else, thanks so much for tuning in. It was SF Live with special coverage from the New Orleans Investment Conference. Leave a comment, leave a like, follow us on YouTube, follow us on Twitter, and we'll be back with lots more content from this fantastic conference.